Welcome to Introduction to Finance, Chapter 2, Reviewing Financial Statements. This will be a little review if you've had accounting, and hopefully it'll cement some of these concepts into your mind a little bit better. This is something that you'll want to spend more time on if you haven't had accounting, so we'll be using financial statements a lot as the semester goes on. We'll be covering the balance sheet, the income statement, statement of cash flows, and then retained earnings. Really hit the balance sheet and income statement the hardest. The balance sheet, digging right in, shows assets on one side or on the top, and then liabilities and equity on the other side. Assets are everything that we've bought or we have a value in the business. So we paid for those things somehow, and that's what liabilities and equity show us. Liabilities show us what we financed with debt. So that's money that we borrowed to pay for those assets. Equity shows what the owners have invested, or whenever we've actually made money and reinvested in the company through retained earnings. Retained earnings, remember from the first chapter, is when we reinvest our income we've made. So both sides have to equal. Everything on the asset side has to equal on the liabilities plus equity side. Okay, someone put the money into the business, whether it was borrowed money or owner's money. The organization of the balance sheet shows current assets and then fixed assets or long-term assets on one side. Current assets, things that usually can be converted to cash in less than a year, and they're organized in order of liquidity, meaning the quicker they can be converted to cash, the higher they're listed. So for like a building under fixed assets, you would have to list it on the market, and it may take 2 years to sell. So that wouldn't be very liquid, so it's listed farther down on the list. Current liabilities are usually due within a year, and then you have a long-term debt that's due in longer than a year. So, and then also on that side, the equity section with the details of how owners' money is invested. So we have common stock, preferred stock, and retained earnings, the money reinvested. The difference between current assets and current liabilities is net working capital. We'll be using that a lot in the future. The way we set up our structure of how we get our money, whether it's from borrowed money, debt, or it's owner's money or income, the equity section, that's called the capital structure, and that's a big decision of a financial manager, is what capital structure to have. For an example, Apple has 100% equity as their financial structure. They have no debt, whereas AT&T would have quite a bit of debt. They hope that you continue to pay your phone bill or your cell phone bill, and your internet bill, and that they have continued income that they can pay interest on their debt with. So Apple doesn't have to pay anything on their equity, on their stock. They don't pay dividends right now either. But AT&T, since they have a lot of debt, they actually pay interest on their debt and dividends, high dividends actually. So that structure, the more you use debt, the concept is called leverage when you use debt, especially to get things that you couldn't unless you use debt, like when we buy homes, individuals. Another issue we have on the balance sheet is things that are recorded at book value and what their actual market value is. The accountants make us record things at cost, where, like for an example, this restaurant equipment, we may have paid $30,000 for it. 6 months later, where our business closes and we can only sell it for $5,000. Well, that was the true market value after we bought it, even though we had to carry it at cost at $30,000. Another accountant joke, I joke about accountants a lot since that's my background. Someone who knows the cost of everything and the value of nothing. In the income statement, the second statement we look at is the basic formula is revenues minus expenses equals net income. So revenues, all the money we make from sales or services, minus what it costs to produce the item or the service, and what we have left over hopefully is income, not a loss. The income statement format, it usually starts with sales, so we have sales at the top. A common line below that is cost of goods sold if we have products. If we don't have products, we won't have a cost of goods sold if it's a service. But cost of goods sold is whatever it went into making the product. Like an iPad, it's the materials and the labor it went into making that. Then gross profits less depreciation, something we do for accounting we'll look at later. And then we get to earnings before interest and taxes. So that's more of an operating income picture. We'll use that a lot in the future too in analysis. Then we subtract out interest, highest bracket that the sales fall in, or the taxable income. And so that falls in that next to last bracket there, which happens to be 38%. So margin is just the highest tax rate you pay, or tax rate on the next dollar. Statement of cash flows, we see there is a little more complicated, just because the accountants make things tough for us. And like I said, I joke a lot because that's my background as well, my initial background before finance. But we have to produce what's called a cash flow statement, because the accountants make us record things like depreciation, for example, due to what's called the accrual basis, and that's required by GAAP, or generally accepted accounting principles. We have to record things even though a cash exchange might not have occurred, like depreciation. When you buy a car, you may pay $10,000 for it and it's now worth $2,000. Even though it's dropped in value by $8,000, you didn't spend $8,000 in cash because it dropped in value. You know that happened, but you didn't spend it. Well, the problem is when we calculate income, net income, we subtracted depreciation, and so we have a net income less something that wasn't really a cash expense. So we have to make adjustments for things like that, and adjustments for other things as well, because of this accounting principles. And when you separate those into operating activities, cash flows from investing, and financing activities. Operating is just what it says, from operating our business, the items that go in there. Investing, the things that go in there are dealing with when we make an investment in a building or a machine or some fixed asset like that, or when we sell those things and create cash flow. Okay, when we buy them and cash goes out, or we purchase them, or we sell them and cash comes in. Cash flow from financing activities deals with when we raise additional money or we pay back money. So we either raise money by issuing stock or issuing debt, or we pay back our debt, or we buy back stock. That's the only time that's affected. Okay, and I do recommend you read your book too for more detailed explanation of the cash flow statement as well. It's a little more complicated than the balance sheet and income statement. But we make adjustments for those things we've just been talking about, and I'll let you read the sources of cash and uses of cash, but we're trying to come up with a true picture of the bottom line. You'll see in the way the statement is organized is what our net change in cash was, which is always considerably different from what our actual net income was. Because you may have recorded a large depreciation number, but so you may have a net loss because you had a lot of depreciation. But because cash didn't go out the door to record that depreciation expense, you may have a positive cash flow. And so you made money, but accounting-wise, you actually lost money or had a net loss. So after all those adjustments, we come down to what our actual net change cash and marketable securities is. Free cash flow, another calculation we'll just introduce here, and I'll let you read through the slides, hear what that actually is, and then we'll use that a little bit in the future as well. So in corporate finance, if you take that, there's an example in there for you to go through, and also, okay, and last is a statement of retained earnings. Retained earnings just shows that's the money that we've raised by hopefully having net income when we've made money. So it's if we raise money, if we make money through our sales in our business, that's called net income, and that adds to retained earnings. If we do not, if we lose money, that would subtract from it. But if we pay anything out to investors, that would be a subtraction from it as well. Okay, when we pay investors back, that uses up the money that we could have otherwise invested back into our business. So hopefully that gives you a good overview of financial statements, and I recommend reading the book as well, and understanding those before we get into